Imagine your savings, like a block of ice. Solid, dependable. Most of us think of our money that way, right? Stable.
Secure.
Exactly. But what if the air around it is warming up? What if that ice is, slowly melting, losing its shape, its value?
It's a good picture because our sources suggest that's kind of what's happening right now, the stability we assume. Maybe not so solid.
Yeah, that's what we're digging into today. We've got these really compelling insights, mainly from analyst Lynette Zang.
Right.
And we're going to explore stablecoins, these new financial rules people call it the Genius Act, and some, frankly, surprising history lessons.
And also the case for, well, what some call sound money, gold and silver, especially now.
Our mission here is simple. Pull out the key nuggets of knowledge for you. We want you to understand how all this might affect your financial future and, the bigger global picture, too.
Yeah, the goal isn't just information, it's insight, understanding the why behind it all, so you can see how it connects to you directly.
Okay, so let's jump right in. Stablecoins. It's fascinating how they're often shown visually with gold coin imagery.
It is. Just like the Fed sometimes uses gold coin pictures for dollars in reports.
It gives this feeling of security, doesn't it? Like it's backed by something solid, old school.
Exactly. It's a psychological anchor. But the reality is their stability comes from what backs them, usually fiat currency, like dollars or other assets, not gold itself.
And the growth rate. It's just wild.
Oh, absolutely explosive. The market was around, what, $125 billion in 2024?
Yeah, something like that.
But the projections our sources point to, they see tremendous growth. Maybe $2 trillion worth by 2028.
$2 trillion, that's a huge shift in capital.
It is, and it sent shockwaves. The Federal Reserve Bank of Kansas City, for example, they put out a report.
Right, I saw that. They said stablecoins could boost demand for treasury debt.
But, and this is the key part, only by reducing demand for other things, specifically bank deposits.
Okay, so unpack that. Money moves out of my regular bank account and into stablecoins. What does that do to the bank?
Well, think about it. Banks use your deposits to lend out money. That's their business model, basically.
Right.
If deposits shrink because money's flowing into stablecoins, which then often buy treasury debt, the banks have less to lend.
So it could squeeze lending, create maybe deflationary pressure, as the source puts it, on the banking system itself.
Potentially, yes.
Yeah.
Less lending capacity could mean tighter credit conditions across the economy.
And Wall Street's reaction to all this is telling, isn't it?
Oh, yeah. First, they dismiss them, call them pet rocks, things like that. Then, almost overnight, this massive flip. Suddenly, the big players are rushing in, trying to dominate the stablecoin market.
It's like they suddenly saw where the future, or at least the profit, was heading.
It signals a major shift. They're not just watching this new system develop, they plan on controlling it.
Which brings us to something really critical, maybe even a bit scary for the average person. Stablecoins are not FDIC insured.
That's huge. Absolutely crucial to understand.
We rely on FDIC insurance, right? That $250,000 guarantee on our bank deposits. Our source says losing that replaces a century of consumer financial protections.
It really does. It fundamentally changes the game. Your money in an FDIC bank, federally backed. Your money in a stable coin.
It's backed by the issuer, right, their reserves.
Exactly. Your safety depends entirely on that private company, their solvency, the quality of their assets. The risk shifts from the system directly onto you.
That's a profound change in who bears the risk.
It is. And it's not a small detail.
Now, this idea of private companies issuing their own money, it might sound new, but our source draws this really stark historical parallel.
Right, to the Wildcat times, late 1800s America.
Yeah, described as a time when men went to bed rich and woke up penniless. That really grabs you.
It should. Back then, you had thousands of banks, often out in the sticks, basically printing their own money, their own banknotes.
With not much regulation, I imagine.
Very little. And often, not enough real assets, like gold or silver, to back up all the paper they were printing. It led to, as the source says, wild and reckless speculation. Currency inflation was rampant.
And if one of those banks went bust?
Poof, your notes were worthless overnight. You could lose everything, even if you thought you were rich on paper.
So the parallel is, today's stablecoins could be like a modern version, a free ticket for big corporations, Amazon, Walmart, banks to issue their own digital currency.
That's the argument the source makes. It's like history rhyming,
Yeah.
Different technology, but maybe a similar dynamic of private money creation with potential instability.
It definitely makes you think. And this isn't just happening on its own. Laws are shaping it. Let's talk about that Genius Act.
Right, the source calls it that. FICLI, it's the Financial Innovation and Technology for the 21st Century Act, or FIT21, signed by President Trump.
And the claim is it fundamentally changed the global monetary system, that it's the first legal foundation for crypto and stablecoins in the U.S.
That's the source's take. It sets up a regulatory framework. And a really key part is that U.S.-issued stablecoins must be backed one-to-one by dollars.
Okay, one-to-one dollar backing. What's the implication there?
Well, the analysis is that this creates that artificial market for dollars and treasury debt.
How so?
Because as stablecoins grow, remember that $2 trillion projection, they need dollar assets to back them. So it forces demand for U.S. dollars and U.S. government debt.
Ah, okay. Especially since, what, 99% of stablecoins are dollar-based now?
Exactly. And they're getting picked up a lot in developing countries with high inflation, so it kind of extends the dollar's influence in a way.
But then there's this other part of the act, the part about safe harbors and exemptions for digital assets. This is where the source gets really concerned.
Yes, this is critical. The act tells the SEC to create these special exceptions.
And the source's interpretation is pretty blunt. If corporations using these exemptions screw up, there ain't nothing you can do about it. What does that mean, practically?
It means these safe harbors can shield companies from liability, especially early on. It's framed as encouraging innovation.
But the risk...
The risk, according to the source, is that it weakens accountability. They draw a line straight back to 2008. Remember, awful stuff happened, lives ruined.
But nobody went to jail.
Because technically it wasn't illegal under the rules at the time. The fear is these new rules are doing the same thing, legalizing this very risky and speculative behavior in the digital space.
So the innovation exemption means the public could be left holding the bag if things go wrong. We're the guinea pigs.
That's the warning. When these new things go south, the public bears the brunt, while the innovators might be protected by these exemptions.
And this isn't just a U.S. story, right? It fits into a bigger global picture.
Absolutely. The source points to this long-term trend. Foreign buyers are slowly backing away from U.S. bonds.
Which have always been seen as the bedrock, the foundation of the global financial system.
Exactly. Losing that core buyer base is a huge deal. It signals waning confidence in the traditional system.
And at the same time, we're seeing this cost of living crisis getting worse everywhere.
Yeah, the source warns that historically, in these big shifts, the majority of people suffer badly. Like 80% of the population ends up in abject poverty, and the middle class gets squeezed, even wiped out.
That's grim.
It is. And you see signs like buy now, pay later becoming huge, not just for luxuries, but for groceries. People can't afford basics.
And the supply chain problems from 2020 haven't really gone away either, have they?
No, they're still lingering, adding pressure.
Then there's this other layer the source brings up, the surveillance economy.
It's a worrying trend. Think about Canada freezing trucker protester bank accounts.
Or people getting jailed in the UK or Germany for social media posts. The EU's Digital Services Act.
Right. The source asks, is this rise in authoritarianism a symptom? Are governments losing control because of funny money and debt, so they need more control over the population?
Needing to subjugate the population, as the source puts it, to manage a potential collapse.
That's the theory presented. It connects to this idea of eroding confidence. The source tracks it. Bank-to-bank trust broke in 2008.
Okay.
Central bank-to-central bank trust, maybe around 2015.
Right.
Market-to-central bank trust, perhaps gone by 2022.
So what's left holding it all together?
Only public confidence. And the source is clear. That's not a good plan when all the other layers of trust have decayed.
Wow. Okay, so given all that uncertainty, the source makes a strong case for sound money, physical gold and silver.
Yes. The core idea is simple. Governments can't just print more gold or silver. They cannot inflate it away like they can with paper or digital currency.
Which might explain why central banks worldwide are buying up gold like crazy.
It reflects that enduring value, that need for a confidence anchor.
But here's the twist. The source also says the markets for gold and silver, the spot prices we see, are admittedly manipulated.
Yeah, that's a fascinating point. They mentioned the Hunt brothers trying to corner silver in 1980.
And the government stepping in to manipulate the market against them?
Right. Overtly. And more recently, look at the SLV Silver ETF. Big news when they changed their prospectus.
What did they change?
Essentially, they don't necessarily have to hold the physical silver anymore. They just need to imitate the spot silver market. It decouples the paper price from the physical metal even further.
That seems significant.
It does. And then you see things like the Saudi central bank buying a big chunk of SLV shares. The source questions if that's another kind of manipulation, maybe a backdoor way to get claims on physical silver.
Plus, silver is now on the U.S. strategic minerals list. It's clearly important.
It is. It's not just about money. It's industrial, strategic.
So if the market price is manipulated, what's the real value? The source gives some incredible numbers.
Based on historical ratios, connecting the value of metal to the money supply.
Yeah. They estimate gold's fundamental value could be somewhere between $33,000 and $40,000 an ounce.
$33,000 compared to today's price.
Makes current spot gold look like a ridiculous bargain, in their words.
And silver. The estimate there is $1,300 to $2,000 an ounce. Again, vastly different from the current market price.
It really forces you to ask, how big is that gap between the manipulated price and the fundamental value?
It's a core question the source wants people to consider.
Okay, so with these kinds of fundamental values and the state of currencies, what about gold revaluation? Is that on the table?
Well, the Fed is apparently looking at how other countries have done it. Our source sees a U.S. gold revaluation as pretty much inevitable.
Inevitable. Why?
As a way to restore public confidence after a potential massive failure of the current system, maybe hyperinflation. It's like hitting a reset button.
How does that work historically?
Typically, a government faces currency collapse. They'd lop off zeros, create a new currency. Gold's price would have shot up massively in the old worthless currency.
Right.
Then, its value gets reset against the new currency. But crucially, gold holds its purchasing power through that transition. While other things crash, gold acts as a bridge.
Keeping value intact between the old system and the new one.
Exactly. And then it usually starts climbing again immediately in the new currency. It's a historical pattern.
So the ultimate argument is about regaining control, personally, with assets you can actually hold.
That's the core of it. Physical gold and silver are described as the only financial instrument that runs no counterparty risk.
Meaning
its value doesn't depend on someone else's promise or solvency, unlike a bank deposit or even a stablecoin, which absolutely has counterparty risk, the issuer.
So stablecoins might turn your safe checking account money into something with risk you didn't have before?
That's the concern highlighted. It boils down to financial sovereignty, owning something real in a potentially fragile system.
So wrapping this up, what's the main takeaway for you listening? Our source is emphatic. This isn't theory. It's not the future. It's already unfolding right now.
Yeah, the changes are happening. And the suggested path forward. It involves that sound money strategy, yes, but also building surety in your life.
Surety. What's that stand for?
It's an acronym. Food, water, energy, security, barterability, wealth preservation, community, and shelter.
Ah, okay. So resilience beyond just finance, looking at the whole picture.
Exactly. Comprehensive preparedness.
And here's one last really provocative thought from our source to leave you with. What if just 3%, only 3% of people globally decided to convert some of their fiat money into physical gold and silver?
The suggestion is that small percentage could be enough to make a massive difference, to potentially shift the system.
It's an invitation, really, to think about how individual choices, when added up, could actually reshape the future of money. What would that look like? Something to definitely mull over.